In January 2026, the IMF projected global economic growth would hit a healthy 3.3%. Just 3 months later, they slashed that forecast. They aren't alone. The IMF, the World Bank, and the OECD are all tracking a series of compounding risks that could push several major countries into a severe economic contraction. We often hear the word recession treated as a complex academic concept, but at its core, it simply describes what happens when an economy loses its speed. When forward momentum stalls, sales drop, investments freeze, and jobs are cut. It creates a feedback loop where people spend less, dragging the system down further. Right now, no major forecasting body is declaring that a global recession is a mathematical certainty for 2026, but they are warning that the buffer protecting us is getting dangerously thin. To figure out how close we are to the edge, we must look at the specific roadblocks threatening to jam the global economic engine, and by extension, drain your household budget. The pressure on your wallet doesn't start at the local grocery store. It begins thousands of miles away with geopolitical instability, particularly the ongoing tensions in the Middle East. This map highlights the Strait of Hormuz. It operates as one of the tightest and most critical transit choke points for the world's energy supply. When military activity or climbing trade tariffs threaten routes like this, the physical movement of shipping containers bottlenecks. Corporations delay their international investments because they can no longer accurately predict when their materials will arrive. Any threat to those transit routes immediately drives up the cost of a barrel of oil. Because the vast majority of our global infrastructure still requires fossil fuels to operate, expensive oil means it costs significantly more to manufacture physical goods and ship them to consumers. A regional conflict on the other side of the planet forces up the baseline operating cost for almost every business on Earth. When those production and shipping costs rise, businesses pass the burden directly to you. That is why the price tags on everything from construction materials to basic groceries start to climb. This graphic illustrates their primary weapon. They intentionally hold interest rates high, attempting to make money more expensive to borrow so that consumer demand cools down. But that strategy directly penalizes the average buyer. Mortgages, car loans, and carrying a credit card balance suddenly require much heavier monthly payments. Squeezed by high grocery bills on one side and expensive loan payments on the other, consumers do the only mathematically viable thing: they stop spending. When millions of people pull back their spending at the exact same time, corporate revenues fall. The entire machine loses its speed, locking in the precise conditions required for a recession. Not every country will absorb this shock the same way. Survival over the next year depends entirely on how an economy is built to handle expensive energy. European nations, for example, are heavily reliant on imported energy. Any disruption to the flow of foreign oil and gas puts immediate, severe pressure on their domestic manufacturing. India is highly exposed to those exact same import costs, as its massive domestic market demands a constant supply of foreign oil to function. However, India also boasts one of the fastest underlying GDP growth rates on the planet. That sheer volume of rapid economic expansion acts as a powerful shock absorber against high prices. The United States faces its own internal challenges with stubborn inflation and slowing job growth, but it is uniquely insulated by its ability to produce massive amounts of its own domestic oil and gas. A country's economic fate in 2026 will be determined largely by these internal buffers and how well they block out external supply shocks. There is also a massive counterweight pulling against this downward global trend: artificial intelligence. Billions of dollars in capital are currently flooding into AI research and the construction of massive data centers, artificially propping up global economic growth. This capital is highly concentrated, specifically boosting the technology sectors in the US, Taiwan, and South Korea. This intense influx of tech funding acts as a financial shield, actively offsetting the economic drag caused by rising tariffs and expensive oil. The global economy isn't in a guaranteed freefall. It is locked in a violent tug-of-war between the heavy friction of geopolitics and the massive financial lift of new technology. Your financial security over the next year hinges on exactly that contest, whether the rapid deployment of AI and strong regional industries can hold the line against the cascading effects of global conflict.